at the by assuming that we are certifying this projection. That's why if you are following a you are holding a COP and you are having a practice of your own, or you are part of a CA firm, this part you need to be very careful. If you are working under a private limited format, that means there are so many firms who are operating this practice under a private limited format. They are not directly governed by the CA Institute Code of Conduct, because those private limited companies are not part of the CA registration, but maybe the underlying professionals who are working there are chartered accountants, so that care one has to take. Second thing about the fees on valuation assignments, particularly again if you are holding a chartered accountant certificate of practice, our code of conduct of the institute prohibits you to charge fees based on the underlying value of the asset which you are valuing. That means if you are valuing shares or you are valuing any asset, we are not allowed to give an engagement letter to the client saying that I will charge you 1% of the whatever value we get. We are prohibited to do that. Merchant bankers are allowed to do that because they do not get covered by our code of conduct. So you will find this difference. I have seen so many engagement letter issued by chartered accountant firms which has linkage of fees to the ultimate transaction value. So please avoid that. Typically in a CA firm, your fees are linked to the time which you are going to spend. So your quotation, whatever you give to the client, will have to be linked to the estimated time on the assignment which you will have to sort of incur. Otherwise, if you try to link it to the value, you may get direct under any of our CA Institute's regulation. So that is on the code of conduct. Second is another, I think, very common feature we have seen in various valuation reports. The heading of the valuation report says valuation certificate, and the conclusion paragraph says, I or we hereby certify that the value of this company is so and so. And as Parag mentioned, it's a very subjective exercise, and I think Cadbury judgment has given this clarity to every individual who has read that it is a subjective assessment, it's an expression of an opinion. So generally your conclusion paragraph should be that in my opinion or in our opinion, the fair value of the company, as explained in earlier paragraphs with using of various methods, and the weightages which we have given is so and so per share, or is value of the business in our opinion is so and so. So avoid using the word certification because it's an expression of opinion. There are so many aspects in our valuation where there are subjective judgments of value which are involved, and no two individuals will be able to ever come to a common conclusion. Even within our own firm we have differences of opinion for a particular item of adjustment. So it is not possible that two separate firms will ever come to a common conclusion on that. So it's not a certificate. You can issue a net worth certificate, but valuation is an opinion. So this differentiation you must keep in mind. Another thing, again, which is very peculiar in the current time, is the unreasonable timelines which are given to do the valuation. If I go back to the history when I started my career, if I tell a client that I will take about 6 weeks time to do the valuation, client was very happy, and 6 weeks he was considering as reasonable timeline for doing the valuation. Of course, that time you will appreciate the technology support was also quite limited. But now we have instances where on Thursday night we get a call for a client who wants to hold a board meeting on Monday morning. Now that is possible only one if the client is ready with the proper information and he gives you accordingly appropriate support, or and your team also is equally equipped to turn around this transaction in such a short time. Both are present, then only accept such assignments. Because having accepted an assignment with such unreasonable deadlines, to a regulator, tomorrow if your valuation is challenged, you will never be able to say that I got only 3 days, that's why whatever I could do best I have followed, and that's why don't ask me very questions on a very detailed query. So that is where one has to be very clear that if a client comes to you and if he is too unreasonable, you have to decide whether you are equipped enough to do this assignment and within those kind of guidelines, timelines or not. If you ask me my experience, in 90% of the cases where we refused the assignment because time was too short, we got a call next day morning by the client that okay, take 7 days or 10 days as you need. So sometimes these timelines which are given to us are unreasonably created by the intermediaries, knowingly or unknowingly, to make sure that we don't spend too much time on the whole assignment. But as I mentioned, regulator is not going to buy this argument. We have to safeguard our interest by either saying no if we are not able to do it, and if we say yes, we have to do the full justice to the whole assignment. Another problem in the current times we have seen is promoters asking for very unreasonable results. That means if according to me the fair value of the company is only 100 rupees a share, for some reason they want say 200 rupees a share. So again, those kind of pressures are put on the professionals for achieving something which has ultimate impact on either the future transaction or some regulatory approvals which they want to take. Again, as a professional, my suggestion would be that whenever you take up such assignments, if promoters wants to have an unreasonable result out of you, you have to stop at the stage where you feel that beyond this I can't do. See, again, it's a subjective thing, so you have elasticity band which is there. That means if my fair value is today 100, I may say that okay, anywhere between 100 to 80 to 120 I am comfortable, because by changing of certain parameters after refining, I can reach that level. But if he wants 200, you have to stop at the stage. So you should know what is your cutoff, what is the deal breaker, as we may call in the investment angle terminology. What's the deal breaker? So at some stage you will have to get up and say, sorry, I can't do this assignment. There are a number of instances where such assignments are refused because you are not able to sign off on a particular value which they want. We see that after 15 days it gets reported on the stock exchange website that they got the value which they wanted. But good luck to them. I think we should know where we need to stop, because goodwill, once it requires lots of years to create a goodwill, but one assignment can take away your goodwill for so many years. So be very careful when you accept such unreasonable assignments. Yes, I understand my younger friends may say who are in practice that it is a very ideal situation. Maybe after some years you can say that, but when you want to build your practice, you can't follow this kind of strict rules. But let me tell you that in the long run, this principle only will help. So, okay, then let's move to another point which I thought is very important, is the perishableness of this kind of assignments. That means, if I do a valuation and if I send a draft working to my client, I have again learned from my practical problems which one has faced, that you have to tell the client very clearly that this valuation is valid for so many days or so many weeks. Because beyond the point, as I think Parag also has covered, that it's a very dynamic situation. You can't. I have so many instances where we get a valuation workings done, send it to the clients, and we get call after 6 months that yes, we have accepted your valuation. Please issue the report. Tomorrow is our board meeting. Now within that 6 months, so many things, underlying factors could have changed. Factual aspects relating to the company could have changed. Regulatory format could have changed. Maybe tax rate itself could have changed. You don't know, so many things would have happened in that 6 months timeline. So you have to put a timeline to the draft workings, and I have seen some clients asking you to issue report only when they want to finally do the deal. Till that time they will happily sit on our draft workings. So there you have to be a little careful that you have to inform him that this is beyond a particular days. If this assignment goes, I need to relook at various factors which I have captured in the calculation. Another important thing is relating to the engagement letter which we issue for this. Of course, I'm sure Anup is going to take you through the actual context, but 2-3 things relating to the engagement or such assignments which I feel is a very important thing, is when you accept such assignments. I have so many instances where I get a call from a friend that we need to value a company 100 crore turnover, 5 crore fees, 5 crore profit, what will be the fees and how many days you will take. And as a good friend, we reply on the phone that okay, chalo, 100 rupees we charge. That's not the real fee we charge. We will just tell him that this is the timeline, okay, we will finish in 7 days and this will be our fees. But when the whole accounts arrive, you realize that it had 5 investments and you have to spend, actually you have to do 6 valuations. So you have to know exactly your scope of assignment. So whether you are valuing 1 company or 6 companies, maybe you still do 1 valuation because you will use consolidated results. If all the 5 companies are in the same line of activity, maybe you look at the consolidated EBITDA and apply a multiplier to that. So it's possible that you still do 1 day, but you must have first access to the financials before you give them a fee quotation and the time estimate. Because sometimes you may burn your fingers by accepting something which is very aggressive in terms of timeline or which is very conservative in the fee estimate. So that also care one needs to take. Another thing, when you get into the engagement letter, you have to be very clear to your client that when you do a valuation, it is not inclusive of even a due diligence service. In number of board meetings, this kind of confusion arises, and we are asked, when we present a valuation, we are asked the question by some independent director that I hope you have looked at the receivables and they are good. We have to then tell them that no, we have just done the valuation exercise, we have not gone into the due diligence aspects because that was never our scope. But they are under the impression in many cases that once the valuation is done, you have gone through each and every aspect relating to the company and compliance. In fact, sometimes for acquisitions, when we make presentation to the acquirer for the target company's valuation aspects, they will ask us, have they complied with all the laws? Is environment clearance in place? These kind of questions many times are asked because of ignorance or whatever. So when you take up such engagement, be very clear in your scope and write that very specifically in the engagement letter. Other aspects of engagement letter, I am sure Anup will take you through. Then we come to a very important aspect about valuation reports. There are different formats of reports which are floating in the market, if I may say so. There are some valuers who will issue just 2-page report. There are some valuers who will issue 50-page report. There are some in between. Every seminar we speak, we get a question that can we get a draft report from you, typically how you issue the report. Nowadays you don't need to ask anywhere a draft report. Just go to Bombay Stock Exchange website. There are 24F filings where all the deals, either you call it as merger, demergers or any scheme where there is a restructuring which has taken place, the valuation report and the fairness opinion by the merchant banker is uploaded on the website. So you can now see valuation reports issued by every single firm. You just look at the 10 different transactions, you will find reports of all the firms which are available on the net. So you can use those reports. Only please, my request is don't do cut and paste job. I have read one report where we typically write that SSP and nor its partners are responsible for blah blah blah, and I could see that report having that kind of line. So please don't do cut and paste job to an extent that you don't even read what you are signing, because that is very common mistake we also make. So we have to learn from our mistakes. Second thing on the valuation report, let me tell you, in India what has happened after the Tomco and Hindustan Lever case, where one valuer did the valuation, company then sought another valuation because the valuation got challenged, and then the court appointed third valuer. After that, corporate India became wiser and they started appointing 2 valuers at the beginning only, so that you have joint valuation report. And this is typical for a merger assignment, where the ultimate deliverable is the swap ratio. So you find so many cases after that. Tomco and Hindustan Lever, I think cases of 1995. So after that, you will see number of large merger assignments where joint valuation reports are sought by the clients. Now typically, you may say that on one side you are saying no two individuals can come to a common conclusion, and now you are talking of a joint valuation report. How typically it works? So in a joint valuation reports, which are when they are sought, the company will first have a meeting with both the valuers. Same set of data is supplied to both the valuers. Typically, whenever a valuer A will ask for any data from the company, whenever the company responds, they will also share that with the company, valuer B, and also they will supply him the question which valuer A had asked, so that both the valuers at the end of the data collection stage have identical set of data. Having seen that data, valuers will typically meet and decide what methodologies they intend to follow in that case, and then they will disburse. Then they will do the valuation in their own respective offices and then come to a common conclusion. Again, if they differ in the conclusion, either they will try to reconcile, or they will see if they come to a common conclusion, then they will issue something which is called a joint valuation report, which on the same page two valuation firms will sign. What's the advantage of it? Advantage of it is that when such valuations are challenged, the courts have typically taken a very favorable view in favor of the company by saying that if company has followed this process of appointing two valuers, where is the question of us appointing another valuer and add more confusion to the whole thing? So typically we have seen that whenever a company was cautious enough to appoint two valuers, and they have obtained joint valuation reports, and those valuers have nothing to do with the company in terms of they are not auditors or they are not consultants to the company, they are independent experts in those subjects. Courts have not taken any adverse view as far as such challenges are concerned. Very quickly, if I may tell you about the practice, I know we have about 5-7 minutes before that. Yeah. Now I'll tell you some points relating to the practice, CA practitioners who are into this valuation exercise, how to build this practice or how to take care of this practice when you are handling such assignments. One is the question will always arise that what is the competence level required to do a valuation. Let me tell you friends, what we are taught in our degree, CA course is more than enough for us to be in this practice. If I tell you, I don't think so many of the valuers in this country, they have not gone through any specific training on this subject. It's mainly by practice we have learned all this over the years. Maybe we were fortunate to be at the right place at the right time, but it's not subject which is rocket science and only few can handle it. So whenever such assignment comes, I have seen many practitioners will just say, okay, this is not my subject, I am into traditional practice, let somebody else do it. Attempt it. If you, as long as you don't have conflict issues, at least attempt that subject and find out. You may find out so many data sources available in terms of reasonableness, in terms of the approaches which various valuers take place. So those kind of backups are available, so that you don't refuse such assignment. If you want to build such practice, you have to at least do the first assignment. Then you can say that yes, I have started this as a practice area. So competence-wise, we are well equipped with this. Only thing what is required is to make a beginning into this practice. Second is that I think we are too much dependent on technology. I'll give you a simple example. One chartered accountant came with his report which he had already issued for one RBI related transaction, FEMA related transaction, where we saw that he had put capital expenditure details in the brackets. Parag has shown that DCF sheet to you. And while giving the formula, again minus sign was used. So capex was actually got added. Now he came to us by requesting that can you prepare a proper answer which I have to give issue to the Reserve Bank of India. I said there is no answer which you can. What's the logic of adding a capex when you are doing a DCF method? There is no answer you can prepare for that. So when I say too much dependence on technology, that we just even don't relook at our formulas when we do the valuation. So use the technology definitely, but don't become slave of that technology. We many times we have this habit of using some earlier Excel files and just changing the numbers. In that you can make a serious error if you forget to delete one cell which is not applicable to this company. Like say in earlier assignment you had surplus line, so you have added that value. If you forget to delete that line, you may end up doing the second valuation with that surplus asset value remaining there. It can substantially change your conclusions. Another thing in your firm, what you can do is have a peer review system within the firm, that any assignment when you do, before it hits the inbox of the client, get it checked by somebody who is not involved in this assignment. So, it will create one extra check within the firm that when somebody who is not involved in the assignment has completely looked at the calculation and the approach and taking the data from the source document, whether it is correctly done or not. At least that part, if somebody looks at it, at least the arithmetical problems which you find in many models can be avoided. What to read? Now you have series of books available on this subject, but they are all foreign authors. Damodaran is one of the, I think, best literature available, but very high-pitched book. In fact, very difficult for a layman to understand this. On DCF, McKinsey has a very good literature. Unfortunately, we don't have a very good literature on valuation where an Indian person has written it from an Indian perspective. There are so many papers which are floated on some residential courses where valuation is captured, or say references which are given by various institutions. There you have certain pages on valuation written, but not something which is a dedicated literature on this subject. Maybe someday, if time permits, one can take up that as an assignment. What are the other reading materials? If you are interested in this restructuring or valuation assignments, read the newspaper, but as Parag mentioned, sometimes newspapers report something without knowing that what is the underlying fact. So best source according to me is again stock exchange website, where company only gives this detail. So it's most authentic source. That means if Imami gives the data that what kind of acquisition they have done as compared to maybe the newspaper, you may find most authentic data coming from company's source rather than coming from the newspapers. Apart from that, various journals issued by SEBI on the subject of various case laws relating to valuation, that those could be very useful read. Another important aspect, just 2 minutes I will take, is on the confidentiality of data. Because you are dealing with listed companies, many times when you do the valuation, you are bound by mostly the non-disclosure agreement will be there between the company and the valuer firm. So you have to adhere to that very strictly, because any data which is confidential in nature, if it goes out of your hand, today under the current insider trading norms, regulations which got published on 15th, which got effective from 15th of May, you can have a serious trouble, not only from your institute but mainly first from the SEBI. And SEBI has now got immense power to take charge of this kind of situation. You have seen in the newspaper so many articles about this thing. One more thing about, there is something called valuation standard issued by our Institute of Chartered Accountants. Valuation standard issued by our institute is today a recommendatory subject. It is not something which is compulsory, but that standard covers. The intention of bringing out that standard was to bring sort of a consistency among valuers, because as I mentioned, one valuer was following certain format, another valuer was following certain format. So they tried to standardize the whole process. Whenever you get a time, look at the institute's website. It is called Valuation Standard, and it's a very well sort of drawn up document, which also tells you the contents of the valuation report, which also tells you the possible clauses in the engagement letter. It's a draft document or non sort of notified document, but I think to the practitioners in this subject, it can be a very useful read. I think these were some of the important points I thought which could be useful to you, but of course Parag and I will be very happy if there are any questions, and if time permitting.
I think I see restlessness on some of the faces, so yeah, we should wind up here. Thank you very much, Sujal. I think the way you spoke shows your mastery of the subject. We need a keynote speaker today. He is the keynote speaker. Okay, so may I now request Hitesh to propose one.
Good evening, friends. You know, this program is generally a key program of our chamber on the valuation topic. And today we are fortunate that it is addressed by